If at first you don't succeed, try again. That applies to the IPO market as well. We have a couple of retreads. One is Caesars. This one is very small. It's only 16 million. But Francis, taking a look at this one looks like a joke. Let's talk about it.
It's really weird. This is Caesars Entertainment in Las Vegas, and they had a good year in 2008, but since then they've lost a lot of money. It's a giantly leveraged IPO. They owe about $20 billion. They have a negative tangible net worth of about $7 billion. But what they're doing is they're registering about 1% of their stock, and so the offering would be about 13 million. But behind that, what they have is they have $500 million. They have actually $773 million of shelf-registered stock from the company and from some shareholders. So they lost about $500 million last year, and I would advise investors don't go anywhere near it. I mean, if you buy it on the offering, because I buy one share and put it up on the wall, but if you buy anything, you're going to get trampled by all this other stock that's on the shelf.
Then there's GSC Holdings. We've talked about this one before, and here we are again. So I can't imagine that the second time is going to be any better.
No, well, what they've done, right? What they've done is repriced this down a little bit in terms of the market cap. The annualized price earnings ratio is still 65, which is really large. What they provide is the kind of black membrane that goes over garbage pits or mining sites or anything outside where you don't want the water to flow. So it's another leveraged buyout. And whenever you see leveraged buyouts, you have to look very carefully, because normally their balance sheet has been damaged by the private equity people, which is the case here. So I would pass on that one too.